Excuse me, sir. So good evening, gentlemen. Good evening.
Good evening.
Good evening.
All right. So again, welcome to today's class. I can see we have started on a good note. Yeah, we have started on a good note with a question from Brian. Yeah. So Brian, you are saying that you have a question regarding our yesterday's class. Please go ahead. What's your question?
Okay, I feel like we have to to explain.
Well, I don't know why, Brian, you are not normally very clear.
Okay, I'm saying, I don't know, am I clear? Can you hear me?
I can now hear you. So always do that. Whatever you've done, you do it always so that I hear you, yeah?
Okay.
Yes, go ahead.
So I wanted to say that it would be difficult for me to ask this question if I'm not looking at that at the solution, because I wanted you to clarify for me something on yesterday's solution.
You want me to retrieve the Excel, yeah?
Yes, sure.
Did I send that Excel to your WhatsApp group?
No, you didn't. You did not send.
I did not send it, yeah?
Yes.
So let me see. Give me a minute. Just trying to retrieve that Excel, yeah? So give me a minute. Okay.
Hello, sir.
Yes?
Alternatively, you could allow me to share at least in that
I have found a copy. I'm just trying to forward to my email, yeah?
Okay.
Why? Because if I want to open that through my WhatsApp, it will take longer, as the WhatsApp has to load, yeah? I don't know why it's not opening that through my, just see. So, Brian, I don't seem to be succeeding, yeah? I don't know whether we can look at this much later.
Okay, no problem.
Is it okay?
Yes.
Yeah, or what you can do is can you just side chat me to tomorrow when you have free time, yeah? We get to look at that, yeah? Is that okay?
Okay, maybe really quick, I would like to say that maybe yesterday while we were calculating NPV,
Yes.
I saw we deducted depreciation in the first place. Then we didn't remember to add it back before calculating NPV, or that is how it's supposed to be done.
No. You know, whatever we had in that question was not depreciation per se, yeah? That was capital allowance. You were just told that it is the depreciation for tax. When you are told it is the depreciation for tax, then that is capital allowance. So what you do is just to minus from the taxable profits directly.
Okay, without adding back.
Without adding back.
Okay.
Okay. If you had depreciation and capital allowance, then of course we know that you first add back the depreciation element, yeah? And then you minus capital allowance. But we didn't have the accounting depreciation. We had the depreciation for taxation, which is the capital allowance. So capital allowance is normally an allowed expenditure that you minus from profits before you tax the profits. So there was no element of adding it back. Sawa sawa.
Okay.
All
So
right.
in which form can the question be said such that
You add
we
back.
should be able to differentiate that this is an allowance and this is depreciation?
When you have the accounting depreciation, it will be very direct that it may be arriving at a profit of so much amount, so much depreciation expense had been deducted. It will be very clear. So separately, you will then have capital allowance. When you look at the question which we did yesterday, it was very clear. It was very, very clear, yeah, that we had only capital allowance. In bracket, you are told that that was depreciation for tax. When you are told it is depreciation for tax, then the other name for it is capital allowance. Otherwise, in a question where you have the two separately, it has to be very clear as to which one is which one.
Okay.
Sawa sawa.
Sawa.
All right. So I think we can proceed to the issue of what I wanted us to discuss very briefly today. That is the sensitivity analysis, yeah, which is also something you have done before. And so it will be a matter of we remind ourselves, and then of course we proceed on to the actual discussion within Excel, which is what in PDA, then we should concentrate on, yeah. What do we mean by sensitivity analysis? Anyone?
I will try. I can try.
Yes, please go ahead.
Okay, sensitivity as the way I know from FM, it is how a project's revenue or income or maybe cost can change in relation to its present values.
Okay. And so that is Brian. The other gentleman is who? Ian. Ian, how do you look at sensitivity analysis?
Yeah. So for me, I'd say how it is how one variable can change in relation to change in other variable.
Oh, wonderful, yeah. Yeah, so both of what you have said are very correct, yeah. Both of them are very correct because that is what sensitivity analysis looks at, yeah. So it analyzes change, yeah. It analyzes change. It analyzes what we call change in one variable, change in one variable caused by, it analyzes change in one variable caused by change in another, yeah, caused by change in another variable. So that, of course, in this case, you can give very many examples, yeah. So the analysis of change in, say, variable A. When you have a change in another variable, say variable B, that is what we mean by sensitivity analysis, yeah. So when one variable changes because of a change in another, then you say that the variable is then sensitive to that other. Normally, in this case, we look at, we analyze, it analyzes, yeah? It analyzes change. It analyzes change in what we can call the dependent variable. In what we can call the dependent variable, of course, are caused by what? Caused by a change, caused by change in the other variable, which we call the what? Which we call the independent, yeah? Which we call the independent variable. So it analyzes change in the dependent variable caused by change in the independent what? Now variable, yeah? Let me just give an example here. You may have a dependent variable like which one? We have, for example, been talking about, so far we have been discussing NPV, and NPV could be a dependent variable dependent on which independent variables? NPV could be a dependent variable dependent on independent variables like which ones? The factors which determine NPV, include things like the initial outlay, yeah? So things like the initial outlay, things like cost of capital, things like the cash flows, things like the other cash flows, things like, of course, the salvage value, So of course the salvage value, and of course many others. Many others. So in this case, we shall be saying that a dependent variable like NPV is then, of course, sensitive to changes in independent variables, like these which we have listed here. So when any one of the factors here is changed, the value of NPV, must change. If I change something like the initial outlay, then obviously NPV will change. The same thing will happen if I pick something like cost of capital. If I change it from so much percentage to another percentage, yeah, then of course my value for the NPV will of course also change. So the study of how NPV then behaves when we change any one of these is what, of course, sensitivity analysis is all about. And of course, we shall note that sensitivity is one-dimensional in the sense that we analyze the change. We analyze the change in the dependent variable. When we change only one independent variable, remember, holding the rest of the independent variables, let me say that constant. So holding the rest of the independent variables constant, and I'll explain. If we want to study the change in NPV, we can only look at the change in NPV when we change, for example, the initial outlay alone. We must therefore hold constant. The rest of the factors, or the rest of the other factors. You cannot, for example, study change in NPV when at the same time you change the initial outlay and also change, for example, the cost of what? Capital. We shall be looking for what is the change in NPV when only one of the independent variables, we change them, remember, at a time. So we cannot look at change in two or more independent variables at the same time. Only when you change one, how does the dependent variable behave? The rest of the independent variables, remember, you hold them what? Now constant. So that's a very important point to note, of course, in this context, as we then proceed to analyze what? Sensitivity. So if that is the case, our next concern will be to look at an illustration, which then tests on what? The analysis of the behavior independent variables when at a time we change any one of the independent what? Now variables. On that note, we shall be looking at, did you guys see the question which I sent to your WhatsApp group earlier? Did you guys see it? There is a question which I sent, there is an Excel which I sent earlier to your
Yes.
WhatsApp group. Please access it. There is some question there which I want us to look at, yeah?
Zimbabwe. Ayudo ng'ato mosechulo, omiya link atemane.
Enoch and Josephat, when you log in, can you please do everything on your side, yeah?
Yeah?
Josephat,
Yes?
you are receiving the whole class, please on your side.
Hello? Yes.
Yeah, so you have to be mindful of the whole class, gentlemen. Remember, we have the rest of us, yeah? So let's proceed on to look at that question, that example. So let me hope it is the one that I am sharing. Let me hope it's the example which I am sharing currently on your screen, yeah? Yeah, so consider the following info about the investment in an equipment. Then we have project duration, which is 3 years. So let me give you a minute to access that question if you haven't accessed it, yeah?
Connected.
Josephat, you are saying hello in the chat. What's up? Do you have a question or do you have a concern, Josephat? All right, so that is the question which we are referring to. And so it is what I want us to look at. All right, so the question reads that consider the following information about the investment in an equipment. The project duration we are told is 3 years, yeah? And then cost of capital we have 15%. And then we are told that cost of the equipment we have 500,000, and then salvage value of the equipment we have 80,000 shillings. The sales revenue per year we have 600,000 shillings. The variable overheads per year 350, and then the fixed overheads per year we have 40,000 shillings. The question requires 4 things. One is that we compute NPV of the project, and then we proceed to advise on the project viability. Yeah. So one, we compute NPV of the project, and then we proceed to then advise on the project viability. So let's start with that. Let's start with computing NPV and then advising on the project viability. So we'll say that we have the solution. Yeah. We'll say that we have the solution, and so we are starting with number 1, where we are computing NPV, and advice, and the advice on what? On project viability. So NPV and the advice on project viability. Now, before we can calculate NPV, you have to remember that we need the summarized cash flow. What in the last question we did, we had called the relevant what? The relevant cash flows. So that per period, we start by determining how much is the net relevant what? Now cash flow. So I'll say that we start with the working. And in this working, we determine the relevant, yeah? The relevant cash flow per period. Now, let us remember that we start with period 0. You must always start with period 0, yeah? And then we are told that the project is a 3-year project. So we have year 1, we have year 2, and then we have year 3. So which cash flow did we summarize that normally apply to period 0? Which cash flow did we say that should apply to period 0? Somebody. Which cash flow did we say should apply to period 0? Let me see what somebody says in the chat. Brian says that the initial outlay, yeah? So that's correct. So we then start with the cash flow for period 0, and of course say that we have the initial outlay, The initial outlay we are told is how much money? I'll say that this equals what? This equals negative. You have to remember that the initial outlay has to be a negative what? Cash flow. So that equals negative the cost of equipment, we have 500,000. So I'll copy that 500,000. I'll copy that 500,000. I'll copy that 500,000. So that has to be a negative because that's an expenditure. So that has to be a minus. When we come to period 1, which cash flows I should apply? Or before that, let me follow the sequence that we have here. Yeah, you know, after the initial outlay, we are told that we have salvage value. So in our relevant cash flows, the next one, of course, become that salvage value. The next one become that salvage value, and to which period did we say that the salvage value apply? The salvage value is for which period? Somebody? The salvage value should be for which period? So let me see what you say in the chat again. Yeah, Brian says that that's for the last year. So we then come to period 3 and say that this equals what? Now, does the salvage value appear? Does the salvage value appear as a plus or a minus? Is the salvage value a plus or a minus? Yeah, Brian says that that should be a plus. So we say that period 3, now that equals the salvage value is how much? This 80. And so we have that 80 as a plus, followed by which is the next one after the salvage value in this info. You know, we are told that we have sales revenue. So one more cash flow here will be the sales revenue. One more cash flow here will be the sales revenue. And the sales revenue should apply from which year? From which year should the sales revenue apply? So from which year should the sales revenue apply? So Brian says that that's year 1, so correctly so. Under year 1, we'll have the sales revenue. Remember, it's also cash that we receive. So that's a plus. That's a plus. The question was very clear that the 600,000 shillings, that is the sales revenue, that apply per year. So that means that even in year 2, we'll have the same 600,000 shillings. And also in year 3, we'll have the same 600,000 shillings. And then, of course, lastly, we can have the 2 costs. One is the variable overheads. One is the variable overheads. And then number 2, we have the fixed overheads. So one is the variable overheads. And then number 2, the fixed overheads. Now they also applied per year. And the costs, we said, should they be plus or minus? The costs, should they be plus or should they be minus? Somebody. The costs, should they be positive or should they be negative cash flows? Anyone? So in the chat, Brian says that that should be negative. So we'll say that year 1, the variable, that equals to negative 350. negative 350. So that should be a minus, remember? And then, of course, the fixed overheads are similarly. The fixed overheads similarly. Because, again, the costs were per year, then again, you will very simply have the same amounts in year 2 and year 3. Then you'll have the same amounts in year 2 and year what? Year 3. If that is the case, then remember, we do not have another cash flow. If that is the case, then remember, we do not have another cash flow. So this question was that simple. That means that we then add them. That means that we add the cash flows so that we get the net relevant, the next relevant cash flow. The next relevant cash flow, which would be how much per year. So we simply get the total per year, so that we get that summation. So that's what we have. So those are there for the cash flows that you need for you to be able to do what? For you to be able to determine what was required, which is NPV. Those are the cash flows which we need. And so once we have that, we can then proceed to calculate, yeah? To calculate. Let's proceed to calculate what was required is NPV. So how much is this NPV? How much is NPV? So calculate that from these net cash flows. So that if you do that, how much do you get? So let me see what you say in the chat, yeah? So you are saying that you get about 32,000 and some change, yeah? So 32,000 and some change. Yeah, so that in terms of how you compute it, remember you start with an equal sign. And then of course you proceed to say, so start with an equal sign, then say that we have NPV. So in bracket we have rate. Rate is the discount rate or the cost of capital, which in the original question we were told is 15%. So that 15% is what we start with. So we comma, yeah? And then of course we pick the values for period 1 to 3. In this case, so values for year 1 to 3. So values for year 1 to the last period. then you close the bracket, and then you say that plus, now plus the initial outlay. So plus this 500,000. What you get is 32,078.50. And that is the answer for it. That's the NPV which we have. So that is there any question on that? If there's no question, if there is no question, then I want to introduce to you something which we haven't done before. And in this case, I want us to compute the same NPV, but using what I call using an alternative, yeah? Using an alternative approach. So using an alternative approach. And this alternative approach, I could call it the long approach. The long approach of using what we can call the present values. The present values of each cash flow. So using the long approach of what I can call the present value, using the present values of each cash flow. So in case we are required to use more or less the approach that you used in your IFM before, yeah? How would we go about this? The long approach is where we used to first compute the total what? We used to first compute the total present values, remember, of the future cash flows, which you added, and then from it, you deducted the initial outlay. So I want us to use the same approach, yeah? So in this case, I'll say that what? Number one, we have the sales revenue. That is the first what? The first cash flow. The present value for it, you know, this we have said is how much money? The 600,000 shillings per year. And then the second cash flow, we have which one? We have the variable overheads, which we have said that the present value is how much money? 350,000 per year. So the present value is 350,000 per year. And then the other cash flow, we are told we have fixed overheads. And the present value, not present values, these are future values. These are future values. The future value for the fixed overheads, we have been told that this is 40,000 shillings, again per year. Again per year. One other future value that we have is which one? The salvage. The salvage value. The salvage value. And the salvage value, we have 80,000 shillings. Remember, not per year, but at end of year 3. Not per year, but at end of year 3. What you used to do manually in your financial management, remember, was to get the present values for these future cash flows. You could add them, and then of course you could minus the initial outlay. So in this case, if the question wanted that we compute the present value per cash flow for each of these cash flows, the question is how do you go about it? And by the way, your syllabus require that you know how to get present values for this kind of what? Cash flows. And so what I want to introduce is what is the function for getting the present values. If you want the present value of a cash flow, how do you proceed on to do what? To compute it. And so the first thing to acknowledge is this. The first thing that we need to acknowledge is this, yeah? The 600,000, the sales revenue, and of course this applies to the two costs, the variable overheads and the fixed overheads. These are cash flows per year for 3 years. When you have the same cash flow per period, for a number of periods, what did you use to call it? When you have the same amount of pay per period for a number of periods, you see like this 600,000 is per year for 3 years. What do you call such a cash flow? Let me see what somebody says in the chat. Yeah, WPGP says that that's an annuity. So that's correct. So remember that the 600,000 is an annuity. The same thing applies, of course, to the variable overheads, and the same thing applies, of course, to the fixed overheads. So in the case of the first three, we shall therefore be looking for the present values of what? An annuity. We shall therefore be looking for the present values of annuities. When you come to the salvage value, the story changes, remember. The salvage value is not an annuity. The salvage value is not an annuity. The salvage value is actually what we can call a single cash flow. That's what we can call a single cash flow. It only happens once, single cash flow. So it only happens once. All right, so in this column, we can say that we are now computing the present values, PVs. We are now computing the present values, PVs. And please listen to this. We have Excel functions or formulas for present values, whether for an annuity or whether for a single what? A single cash flow. Let me start with the present value for the first annuity. And this I'll say that equal to, when working with a function, you start with an equal sign. And then of course you type what you want to compute. We want to compute a present value, so you type PV. We'll then have an open bracket. Look at what we are told as the formula there below. We are told that we start with the discount rate. And you know, in this question, we already saw that the discount rate, we have 15%. We have 15%, then you comma. Excel then says that you look for something called NPAR. The PAR is a short form of period. So in that case, we are being told that we look for the period. The period in this case is that the annuity is for how many periods? The annuity is for 3 years. So you type 3. You type 3. And then again, you comma. So again, you comma. And then we proceed to PMT. Now PMT is the annuity. PMT means a fixed amount per period for a number of periods. That's what PMT means. A fixed amount per period for a number of periods. You see, like for this revenue, we have 600,000 fixed per year for 3 years. So you pick the 600,000 next. Close the bracket. Close the bracket. Close the bracket. And then, of course, you will press enter. And then, of course, you will press enter. Now, when you do that, look at the figure you get. By default, Excel will give you a figure which is a negative. By default, Excel will give you a figure which is a negative. But of course, the sales revenue we know is a positive cash flow. That cannot be a negative. So we need to make it a positive. If you want to make it a positive, now go back to the formula, click on that figure, double click on that figure, so that we are back to the formula for it. What you'll do is to, before the last cell, in this formula, the last cell is, in my case, it is this F39. Before the last cell, you will put negative. Before the last cell, you will have a negative. Before the last cell, you will have a negative, and then re-enter. When you re-enter, that figure become a positive. So that figure become a positive. And then one thing that I don't like with, Excel is, I think it's an American thing. And so by default, they'll give you figures in dollars. Because in Kenya, we do not report in dollar, you need to remove that currency thing, or just have the Kenya shillings instead. So what you can do is to highlight the figure, then up there, you look for this currency part. Up here, there's this currency thing, this option here. So click on it. When you click on it, I want you to click on that general. When you click on general, the dollar disappears. The dollar disappears. Then you can click on this comma thing to have your figure to 2 decimals. Then you click on that dollar thing to have your figure to 2 decimals. Now, we then proceed to compute the present values for the variable overheads and the fixed overheads in the same manner, yeah? So that for the variable overheads, we will say that equal to, use the same formula, PV is equal to what? The rate is 15%, so PV in bracket, the rate is 15%, comma, NPA, the PA is the period again, so 3 years. And then comma, you pick the PMT. So that one, you don't need to change. You don't need to put a negative before the last cell, because we want that as a negative. That's an expenditure. So that should be a minus. So let that one remain a negative. So if I press enter, I get negative 799. But again, I want to remove that dollar thing. So I click on the figure, and then up there, I will say general. And then, of course, click on this comma to have my figure as an accounting figure. Now, please appreciate what? that for the fixed overheads, you'll compute similarly like we have computed for the variable overhead. So I can simply, or rather, let me just compute it the long way. So equal to PV in bracket, the rate is 15%. The rate is 15%, comma, NPI is 3 years. And then, comma, we have PMT. The PMT is that 40,000. And so again, I'll remove the dollar thing. I'll click general and then that comma. And then lastly, we have salvage value. And then lastly, we have the salvage value. Now, please remember that the salvage value is not an annuity. The salvage value is not an annuity like the first three is not an annuity like the first three. This one is now a single cash flow, which happens end of year what? End of year 3. So the formula for it will almost be the same, only that we would introduce just something small to make that be a single cash flow end of year 3. We'll say that equal to PV in bracket. In bracket again, the rate is 15%. The rate is 15%, yeah, comma, NPA. NPA is the period still. So NPA is the period still, now 3 years. And then you'll comma. Now please listen to this next thing. Because the salvage value is not an annuity, we are saying that this is a single cash flow, end of year 3. We need to do what is called blocking year 1 and 2 so that it only apply to end of year 3. How do we block year 1 and 2? You introduce a 0. After the NPA, you comma, and then you introduce a 0. And then you comma again. And then you comma again. Then, as we've done before, you now go for the cash flow. You now go for the future value. But again, remember, Excel will give you that figure as a negative. So to ensure that we get a positive figure, because the salvage value should be a positive figure, can you introduce negative before the last cell? And then, of course, close the bracket. What makes this present value different from the other two is this 0, which we are introducing here. So like I'm saying, the 0 blocks year 1 and 2. That makes sure that you are now talking about a single cash flow end of year 3. So that has to be very clear. So if you enter, that's the figure which we get positive 52. But again, I don't want the dollar thing. So I go to this currency part and say that general. Then I click on that comma. So in your manual FM, what you used to do, you could add these cash flows. And then after you add them, you could minus the initial outlay. You could minus the initial outlay. And the initial outlay we know is this 500,000. So I bring it there. If I calculate downwards, how much my NPV should be, then remember that we get the same figure as what we had before. So we get the same figure. So that, is there any question on that? Any question on that? Yeah, so why I've introduced this long approach, what I've called the long approach, is so that we know how to compute the present values. Yeah, that's why I've introduced this long approach, because one of the things you are required to know is how do you get a present value. So that you must know. All right, so if that is the case, then I think we will be stopping at that point for today. You know, we had extended yesterday, so we cannot afford to extend today as well, yeah? So that will mean that we shall finish on this question then on Sunday, yeah? You know, we still have parts of it that we haven't done to completion. We've only done number 1, but that has explained a lot to us. When we meet on Sunday, then we shall continue with required number 2 to required number 4, yeah? So on Sunday, I will use the same Excel, because I still need part of what I've done in this part 1 to then be able to answer part 2. So let's stop there. Let's meet on Sunday so that we'll continue from there. So have a good night and God bless. See you guys on Sunday. Santeni.